Ladies and gentlemen, thank you for standing by and welcome to the Stolt Nielsen Limited presentation and conference call for the second quarter results 2020. At this time, all participants are in a listen-only mode. After the presentation, you may ask a question by pressing star and 1 on your telephone keypad. And I must also advise you the conference is being recorded today, Thursday the 2nd of July 2020. I would now like to hand over to your speaker today, Neal Stolt Nielsen, Chief Executive Officer. Please go ahead, sir.
Thank you. Good afternoon, good morning. Thank you for joining us for our second quarter's earnings release. I do apologize for the delay in the startup. We have had some technical issue in uploading the presentation that we are about to hold on our webpage, but you will be able to see the presentation, which I will be referring to. If you go to our webpage and to the section of investor presentations, you will follow it on the webcast. Again, apologies for this. Together with me, as always, Jens Grüner-Hegge is Chief Financial Officer. If we go to page 3, which is the agenda page, I will go through the second quarter highlights. I will take you through the actions we have taken in regard to the pandemic, COVID-19. I will go through each of the businesses. Jens will take you through the financials, and then we will open up at the end for question and answers. If we then move to page 4, which says highlights of Q2 20, better than expected. We reported a net profit from continuing operations of $12.3 million for the quarter, and that's up from a loss of $19.3 million in the previous quarter. Stolt Tankers reported an operating profit of $20 million, and that is up from $4.7 million. That mainly reflects the increase in deep sea revenue, which was driven from healthy COA nominations, strong volume from the COA nomination, a strong spot market, and also increased number of operating days. In Stolthaven Terminals, we report an operating profit of 19.2, and that is up from 18.9. I just got a message in here. The presentation is now uploaded on the website also. Again, 19.2 in the second quarter, up from 18.9 in terminals, as the market overall remains stable. Utilization rose to 95% in our wholly owned terminals and to 97% in our joint venture terminals. Stolt Tank Containers reported an operating profit of $13 million, and that is up from $6.7 million in the first quarter. That is a result of higher demurrage and a lower repositioning cost. The total shipments were basically unchanged, though we were able to get a higher utilization by 1.7% compared to the previous quarter. Stolt Sea Farm reported an operating loss of $4.7 million, which includes an impairment of 1.8, and that compared to an operating loss of 8.8 million in the first quarter, which reflected a $12 million write-down of our biomass in the first quarter. We have classified sterling caviars as held for sale, and we have taken an impairment of $8.1 million in the quarter. As always, I will go into more detail when I go through each of the businesses. If you go to page 5, where we compare the net profit from the first quarter to the second quarter for the group, operating revenue came in at $503.5 million. That is up from $479.1 million in the first quarter. EBITDA, that is up from $100 million in the first quarter. Operating profit, $49.4 million, that is up from $17.6 in the first quarter, and a net profit for the quarter of $3 million. Now, I previously reported in the previous slide that we had a net profit from continuing operation of 12.3. The 3 million reflects then the impairment and the write-down we did on our sterling caviar. So if you look at from ongoing operation, we would actually have had a $12.3 million profit. If you look at the variance analysis, we had a net loss of $20.2 million in the first quarter. We have 15.2 million better operating profit from Stolt Tankers, 300,000 better operating profit from terminals, 6.3 million higher operating profit from tank containers. We had a lower operating loss of 4.2 in Stolt Sea Farm, and 5.7 improvement in corporate and other operations from corporate, and that mainly reflects the accruement or a reduction in the accruement of profit sharing to the organization. We had a lower net finance expense of 1.6 due to lower interest rates, slightly higher non-OPEX and FX losses of 1.3, slightly higher income tax of $500,000, and again the $8.3 million Sea Farm loss from discontinued operation. That is again the write-down of the sterling caviar, and that gives us a $3 million profit for the quarter. Moving to page 6, COVID-19, the action list update. Our goal is, of course, to preserve cash. As I reported in the first quarter earnings release, immediately when the pandemic hit us, when we went into lockdown, we were very much focused on preserving cash. And we have taken actions, and we continue to take action. We canceled our dividend, the final dividend for 2019. We cut back on all travel and entertainment and training. The board and the senior management did a voluntary salary cut. We cut back on professional fees and contractors. The total savings from those actions are so far $21 million. In addition, we reviewed all the CAPEXs in each of the businesses, and we identified $62 million which we could either cancel or delay. So a total of $83 million of cash savings that we have identified in 2020. The target then also was to secure sufficient liquidity to weather a substantial downturn. We went through each of the businesses and we asked them to go through a scenario where we do a 20, 30, 40% downside in revenue. Not that we necessarily believe it's going to happen, and this is important to stipulate, is that it is just a preparation. It doesn't mean that we necessarily believe it's going to happen, but we really work under hoping for the best but preparing for the worst. And the market and the world that we live in now is so uncertain, so we want to make certain that we are in a position to ride out whatever comes our way. At the end of the quarter, we had $411 million of available liquidity, very much thanks to Jens and his team of securing the necessary liquidity. We have $65 million financing secured by 2 terminals. The term sheet has agreed upon and credit has been approved, so that's addition to the 411. As you know, we did a successful $132 million bond issue in June, and we're also in discussion of topping up a existing terminal facility in Singapore. And we're also considering an additional $100 million RCF, revolving credit facility. As it stands right now, we have approximately $465 million of cash and overdraft facility available. That's what we have now, and also, of course, then we also have the other finances or opportunities that we are pursuing as listed on page 6. That, as you will realize, will put us in a position to have enough liquidity to repay the bond coming due at the end of in the first quarter in March of 21. It also, with the additional financing beyond what we have already secured, but listed here, we will have enough liquidity to face a 40% revenue reduction and still be able to meet our obligation and still have liquidity reserves. Again, hoping for the best, but preparing for a prolonged downturn. If you then move to page 7, page 8, Stolt Tankers, second quarter highlights. I would like to remind you that the first quarter we had a poor performance in tankers, not very much driven by the COVID-19, but because of the repositioning of ships and the delays in dry docking due to due to ballast water treatment installation and also scrubber installation. So we had around a little over 300 days less operating days in the first quarter compared to the second quarter. So much of the improvement that we see is, of course, the more operating days because we didn't have the delays related to the dry dockings. The operating revenue came in at 293.9 million. That is up from 280.7. The EBITDA went from 49.5 up to 65 million. The operating profit again from 4.7 up to 20, and the operating days rate went up from 618 up to 6,018 up to 6,329. If you look at the operating profit variance from first quarter to the second quarter, our operating profit came in at 4.7, $15.3 million higher trading results, 3.6 million higher net bunker cost. And you have to remember that we are over 70% contractor for freightments, and we have a bunker clause in each of most of those contracts. So when the bunker prices are high, we get a lot of surcharge. When the bunker prices are low, we need to give money back. So that's why under the COAs, we have to basically give most of the benefits back when the bunker prices fall. So our net cost for the quarter was marginally lower, 1.5, but because we had a paper hedge loss in the quarter of approximately $4 million, the net cost for the group came in at 3.6. We had a 2.3 million lower operating expense, slightly higher depreciation of 1.1, and higher equity income from our joint venture of 2.4, bringing the quarter's operating profits for tankers to $20 million. If you go to page 9, the contract that we renewed for the quarter, the contracts that we renewed in the second quarter were on average up 5%. And I would say that under these circumstances, that reflects a relatively strong market, taking the current environment into consideration. It reflects the balance between supply and demand, as it currently stands, is working in our favor. The volume were up a total of 9%. COA volume of 15%. When we have a bigger nomination from the COA, we have less spot space. So our the freight rate overall of the volume that we carried was up 1%. The COA rates that we carried during the quarter was up 2%, while the spot volume was down 0.4%. Now we stipulate in the earnings release that the spot market was strong, and it was strong. But the bunker prices fell significantly in the quarter, so we really got the benefit from a lower bunker price, but the spot rates didn't go down. Utilization went up by 3%, and the sailed-in revenue for the deep sea fleet went up 13% for the quarter. The Clarkson, now of course the second quarter we had a strong MR market, which then meant that the swing tonnage didn't operate that much in our segment, and as a result we saw the strong spot market and then of course enjoy that. If you look at the Clarkson spot chemical index, you can see that toward the end of the second quarter the spot index fell, and I think that unfortunately reflects the fall also in the MR market. And that may be, of course, an indication of what is to come for the third and fourth quarter. If we go to page 10, the average price of the IFO and the very low sulfur fuel consumed was $388 per ton in the second quarter, and that compares to $501 per ton of the price of what we consumed in the second quarter. The average price of IFO and very low sulfur fuel that we purchased in the second quarter was $274 per ton, and that compares to a $546 per ton in the first quarter. As I already mentioned, much of the benefit of the low bunker cost is passed to the customers, as tankers was burning older, higher cost inventory, while bunker surcharge clause rebates based on the lower spot price. So only the net benefit that we had for the quarter was really $1.2 million. If you go to page 11, which is the STJS, Stolt Tankers Joint Service Sailed in Time Charter Index and Sensitivity, you can see a nice significant pickup in the second quarter. And you can read at your convenience the sensitivity. If we have a 5% increase in index, that gives us a net profit impact of 5.6. So every 5% is around 5.6 million on the bottom line for tankers. If you go to page 12, we have a historic low order book in our segment, and I think that it will continue because of the environment that we live in. The order book stands at now at 5.4%. That is slightly up from 5.3 in the first quarter, so there were a few ships being ordered. Not really big ships, but more smaller size ships. During the same period, we also expect that the older ships from 20 to 24, approximately the same amount of deadweight, will leave our segment, but probably towards the later part of that period, while the new buildings will come in the earlier part of this period. The core chemical deep sea fleet growth will significantly drop. So the growth will drop in 2020 and 2021, as you see on the chart here. We do, however, expect maybe that the pandemic is causing delays in the new buildings, in the orders, in the ships that are on order. So, as I stated earlier, we have had a challenging shipping market for a long time, and finally the order book started to come down, and the balance between supply and demand came into our favor, and then this pandemic came along. But still, under these challenging circumstances, we are able to get increases in our COAs, which I think is a reflection of this supply and demand being in our favor, and definitely so going forward. So if you believe in a V-shaped recovery, I believe we will have a very strong market in chemical tankers going forward. 13, and here's the market outlook. It's impossible to predict, or it's very difficult to predict. We're hoping for the best, but preparing for a downside scenario if that comes. The May sailed-in revenue was the highest we have seen since November of 17, and all trade dates were, of course, boosted by the strong CPP or the MR market, and also the lower bunker prices. The US Gulf to Asia market and India market was strong, but we saw weaker demand or weaker shipment demand in the Atlantic, transatlantic east and west, and also in South America. And the MR market is down. It came up to almost $72,000 or $73,000 a day, and it's today around $10,000, maybe even lower. What I can say is that nominations continue to be healthy. We are seeing more swing tonnage coming back into our segment because of the weakening of the MR market. However, again, the nomination are relatively healthy in most areas. July nominations looks pretty good. We are a bit worried about what will happen in August and after that. The European fleet, so I will go through the regional fleet. And the regional fleet, the European fleet is the one that is suffering the most. It's extremely low activity. We haven't seen it that slow. Fortunately, we have a relatively small fleet there, so the financial impact is not that big. If you look at all the regional fleets, which we own 100%, which is the inter-European business, the inland barge business, the inter-Caribbean business, and the transshipment business in Asia, The actual results went from $1.2 million profit in the first quarter up to $3.5 million in the second quarter. So there was an improvement primarily driven by SNITS, the inland tanker business, the barge business, and the Caribbean business, while the European business was very challenging. If you look at the Asia Pacific business, that's what we call SNAPS, which is a joint venture with NYK. We saw an improvement there. We went from a $500,000 loss in the joint venture in Asia to a slight $200,000 profit in Asia. I think that reflects the pickup of activity in Asia, and we expect that SNAPS will continue to see improved performance. If we then move to the terminal business on page 15, and here again we compare the operating profit between the first quarter and the second quarter. It continues to steadily improve. This is again what I call the steady, long-term, steady cash flow coming out of this business. And the team are doing a very good job in managing the situation. You know, we talk about the people that are sitting and working from home, but there are some work that cannot be done from home. Those are the seafarers, those are the operators that are on the front line, and they've done a tremendous job in keeping the operation going. My hats off to the whole team. The operating revenue went from 61.7 in the first quarter, slightly down to 59.7. The EBITDA from 33.4 up to 35.3, and the operating profit from 18.9 up to 19.2 million in the second quarter. And utilization went from 90.5 up to 95.2. If you look at the operating profit variance, the first quarter was 18.9 million, slightly lower revenue. So lower revenue but higher utilization. We were able to secure some trading business from some traders. So we filled up our tanks, lower paying business, but higher utilization. So the overall positive benefit because there was lower operating expenses associated with those contracts. Slightly higher depreciation, higher equity income of 0.4 million, and lower A&G and other expenses of 0.3 million, bringing the operating profit to 19.2 for the quarter. Steady as she goes, and this, I think, this is the segment where I feel the most comfortable because of the contracts and the customer base and the locations of our terminal. If you go to page 16, Stolthaven Terminals performance, stable and steady performance throughout the quarter. The U.S. terminals were stable utilization and stayed at above 90% and fully operational during the lockdown. The Brazil and European terminals saw a drop in chemical throughput, but we saw a healthy ethanol demand in Brazil. The ANZ, that's the Australian New Zealand terminal, and the Singapore terminal saw an increased activity during the second quarter, which helped to increase the utilization to 94, almost 95%, up from 90. The equity income from our joint venture went from 5.6 million up to 6 million to the quarter. If you look at the graph below, it kind of illustrates the steadiness of the performance of this business. And I think it will continue to do so going forward. If you look at the markets, the U.S. market going forward, U.S. market overall steady, but chemical and base oil into automotive industry is still weak. I mean, part of our business is, of course, blue voids, and of course, those are still being stored, but there's very little throughput. We are seeing still lots of inquiries, and we are pursuing lots of opportunities, both in our Houston and New Orleans terminal. Asia, the Chinese chemical market has showed signs of improvement post-lockdown. The Korean market remains stable for chemicals, but Southeast Asia is lagging in recovery. The European market, I think, was probably the most challenging because of the European economy. European market remains steady for chemicals, although the broader market remains weak due to the significant exposure to industries such as car manufacturing. The petroleum storage, which we have at our Otsa terminal in Antwerp, remains strong. The Brazil market steady. The chemical market continues to show signs of weakness, with a pickup expected once lockdown eases. The petroleum and ethanol markets remain more stable, including on the throughput. If you then go to page 18 and 19, page 19 for Stolt Tank Containers, operating profit 135.2, that's up from 129.4 in the first quarter. EBITDA increased from 16.5 to 21.2. Operating profit up from 6.7 million to 13 million, and utilization went from 68.5 up to 69.7. So a very, very good picture. I would like to remind you that we had an issue in the first quarter where we had some higher charges because of the IMO 2020, which had an impact on our results in the first quarter. Also during the first quarter, we had a lot of empty repositionings because of the uncertainty. Tank containers is always an early reactor to changes in the market. So if we compare the first quarter to the second quarter, we had higher transportation revenue of 500,000. We had higher demurrage and additional revenue of 4.3. We have higher other revenue of 0.8. That's like these add-on charges that we give. We had lower move-related expenses in the second quarter, so lower trucking expenses, lower ocean container line expenses. And we had less repositioning expenses. We were hit by repositioning expenses in the first quarter, less so in the second quarter. We had higher repositioning costs in the first quarter, less so in the second quarter. And higher other operating expenses of 3 million brings the operating profit for the tank container business to 13 million for the quarter. The tank container market highlights: demand was firm during the second quarter. Shipments were slightly down, but margins were up due to demurrage revenue. The total shipments were about flat for the quarter on quarter, but actually tailed off towards the end of the second quarter. Volumes into and out of Europe were weak and continue to be weak, but it was offset by good volumes out of the U.S. and South America. The demurrage revenue was up due to strong shipments in February, March, and when the customers received the tanks, they've been holding on longer to those tanks, which again, I guess reflects that the product is not moving through the factory fast enough, and they use our tank containers as storage and then recharge them demurrage, which is good for us. Repositioning costs were down due to well-positioned tanks relative to demand and less intra-regional shipments, so more long-haul shipments. The ocean freight, as I said earlier, has come down as container line market has softened. If you go to page 21, looking forward, this kind of reflects, the bottom graph reflects the development of the tank container fleets, and you can see that we have been growing and expanding aggressively for a long time. And we hope and we will continue to do so going forward. This market continues to grow, and the fundamentals in this market are very strong. As I said earlier, there are more operators, more competition, but through our platform, we are very well positioned to be able to compete profitably, and this market continues to grow. As we see the market now, we see that the Asian markets remain busy and good demand in oil and chemical trade, an increase in exports to Europe. So the Asian export business is doing well, looking healthy. The European export is down due to the lockdown, and also the European demand is down due to the lockdowns in Europe. The South American exports are strong and a positive outlook for the coming quarter. Demand in North America is holding up thanks to the diversification of our customer base. And the food grade business is very strong and doing very well. I guess we tend to consume more alcohol during when we sit at home in a lockdown. After the second quarter, shipments were down. So as we mentioned, we saw a drop in shipments in June, but actually the July shipments or bookings have been picking up again. So it's too early to say. It's very difficult to predict, but we thought we saw a drop in June, or we did see a drop in June, but we actually started to see a pickup again in July. And also this is the summer month, so we usually do see a drop off. So is it because of COVID-19 or is it because seasonal? It's difficult to predict. But overall, I'm bullish that Stolt Tank Containers will do well going forward. Then moving to Stolt Sea Farm, that is the business that has been hardest hit because of the COVID-19. I remind you that the turbot pig, what is it called in Norwegian, the turbot business, is primarily sold to to restaurants and hotels, and all in Europe and all over the world, hotels are closed down. That has impacted our business quite significantly. On page 23, we compare the first and second quarter again with operating profit. Operating revenue, 13.6 for the second quarter. That's down from 24 million in the first quarter. EBITDA negative 1.6 in the second quarter, and that is down from 2.9 in the first quarter. And the operating loss was 4.7 million. That is down from 8.8 million. And I remind you that we did take a $12 million impairment on our biomass in the first quarter, which we didn't have in the second quarter. So operating profit, or actually operating loss, for the first quarter was 8.8. Lower turbot sales in the second quarter, so less volume being sold in the second quarter at lower price. Lower sale of sole. We have lower operating expenses because of the actions that we have taken, and also when you harvest and farm less volume, of course the expenses go down. And we did have the impairment that we had in the first quarter, so less impairment of 11.6, slightly higher impairment of 1.8, and lower A&G of a positive 0.2, which brings the operating loss of 4.7. If you go to page 24, the market has been weak for seafood, especially the high-value species like turbot and sole. We have adjusted our prices to the weak demand, which has allowed us to keep the flow of sales going. And we have switched the sales, and we pushed more into the retail segment rather than the restaurant and hotels. Our action plan, as a result of the COVID, we have successfully taken steps to preserve cash. They have secured their own local financing, so Stolt Sea Farm has not been a cash drain on the group. They have been able to get extra credit from our vendors. We have held back on capex and hire fees, and we have achieved grants from the local government. They have had very much focus on the working capital, and with no relevant bad debt. The reduced OPEX by the reduction of biomass. We have improved the feeding efficiency. We have reduced the energy consumption, and we have tight control of the maintenance expenditures. How does the rest of the year look like? Well, we have written down the biomass. And I think that the value of the biomass that we have now in Stolt Sea Farm is at less than €6. We are now selling above €6. For us to go break even for the remainder of the year in Stolt Sea Farm, we need to have a price of 7.5, and we are down 6.6 as we speak. So I think we have reached the bottom, and the markets are now opening up again. As most of you know, that Spain, Italy, France, they're all opening up. The restaurants are opening up. The hotels are opening up. And we are seeing actually quicker and earlier than we expected a recovery in this market. So I believe the bottom has been reached in Stolt Sea Farm, and hopefully we'll get back to our normal prices quickly. Stolt Nielsen gas, not much to report. We have, as you know, fixed one ship to Petronas, the first ship for a 3-year time charter. Now, the challenge here is, of course, that the ships are being built in China, and they are being delayed. But we're working together with our charterer, with Petronas, and they understand, and we're working together. So we do expect the ships to be delivered at the end of the third quarter, so that we will start generating a revenue there. We also have one ship on bareboat to Golar Power. We believe that that ship will also be the second ship will also be delayed. But again, we're working together with Golar Power, and I expect that ship may slip into 2021. There are high activity, so there's a lot of activity going on in Sardinia on page 27. The terminal that we're building there is also being delayed. We now believe that we will be operational at the end of the year, again driven by COVID. But also we are working on and making great progress in selling LNG to the local market. So it overall looks promising. When we get the cash flow from the 2 first ships, it will certainly help. We do not expect that we need any further equity to be able to take delivery or meet the investment that we have committed to. And that brings me to page 28, Jens, to take us through the financials.
Okay, thank you very much, Niels. Again, good afternoon and good morning to those of you calling in from the United States. I will, as per normal, provide details about the financial results that we released today for the second quarter. And considering the COVID-19 pandemic, I'll also give you an outlook of our cash flow forecast going forward, something we usually don't do, but we thought it was important to share that with you. I want to remind you that we have today filed our financial statements for the second quarter with the Oslo Stock Exchange. And as per normal, you will find the press release, the interim financials, as well as this investor presentation posted on our website, which is www.stolt-nielsen.com under the section Reports and Presentations in the Investor section. So moving on to slide 29. This is the Stolt Nielsen Limited net profit loss overview. Operating profit before one-offs for the second quarter was $51.2 million. That's significantly up from the $29.5 million that we posted in the first quarter. And that's really reflecting the good recovery in both tankers and tank containers, as Niels discussed, and a reduced operating loss in Stolt Sea Farm. Also, terminals had a steady performance, but a strengthening US dollar during the second quarter masked the positive impact of the improvement in utilization that was achieved in terminals. And that was predominantly in Singapore and Australia. During the quarter, you will see we wrote off capitalized expenses of $1.8 million. That was at our sole farm in Iceland. And consequently, the operating profit for the quarter was $49.4 million, up from $17.6 million in the prior quarter. Net interest expense continued to go down and was $33.4 million for the second quarter. And that was a decrease of $1.6 million. And we had an small FX loss of $1 million. The group tax charge for the second quarter was $1.7 million, $500,000 increase from the prior quarter. Also, as Niels mentioned, in the second quarter, we reclassified the sterling caviar business as held for sale. And in the process, we wrote down the assets of the business by $8.1 million. Consequently, we can report a net profit from continuing operations, which now fully excludes the caviar business. So the continuing operations profit was $12.3 million. And that was a good improvement from the loss of $19.4 million in the prior quarter. The loss that we took from discontinued operations was $9.3 million. That is the $8.1 million that we wrote down the business with, as well as the quarterly running loss of $1.2 million. And you will see that we have excluded the caviar business from prior quarters as well. Consequently, the net profit came in at $3 million for the quarter, and EBITDA came in at $122.8 million. And again, note that the EBITDA is before the fair value biological assets, insurance reimbursements, and other one-time non-cash items. Can move on to page 30, please. This time, we have decided to show you a different view of the balance sheet, and we're focusing more on the covenants. If you look in the top left quadrant, you will see that the total debt at quarter end was $2.567 billion, and that's down from $2.585 billion in the first quarter. Tangible net worth remained flat at $1.58 billion, and consequently, we saw that the debt to tangible net worth ratio declined slightly from 1.64 to 1.62. If you want to look at net debt, subtracting out the cash, net debt was at $2.34 billion at the end of the second quarter, as we had a significant cash balance of $230 million. Total assets for the quarter stood at just over $4.7 billion. Looking at the other column, the EBITDA to interest expense to the right, you'll see that with the improvement in the EBITDA that we experienced in the second quarter, the EBITDA to interest expense ratio improved to 3.18 from 3.05 in the first quarter. And keep in mind, this is calculated over the last 12 months. So likewise, our net debt to EBITDA had a significant improvement from 5.64 to 5.27, as you will see in the bottom left quadrant. Our liquidity position at quarter end stood at $411 million. That's made up of $230 million in cash, as mentioned, and $181 million in availability under the revolving credit line. This is down from the prior quarter, but keep in mind at the end of the first quarter we had just raised a $142 million bond to prepare us for the bond maturity, the bond that matured in April of this year, so during the second quarter. If we move on to slide 31, please. This is the capital expenditures program. Year to date, we have done 73 million, but for the quarter, the second quarter alone, we had about $40 million in capital expenditures. Remind you that this excludes what we pay for dry docking of the tankers. For tankers, we spent 12 million on non-dry dock expenditures, 15 million for terminals. STC was about 2 million, and interesting enough, we had a negative 2 million for Stolt Sea Farm, as they received grants related to prior capital expenditures done in Spain. We also invested a further $10 million into Avenir Gas during the quarter, and we had spent $3 million in corporate. That leaves us with about $98 million remaining for the year, and some of the reduction that we had of the 62 million have been pushed in over to 2021. So in 2021 we expect about $89 million of capital expenditures. Moving on to slide 32. This is a different view of our liquidity position, or cash flow, if you like, than what we normally show you. It's trying to give a bit more of a visual view. The free cash flow increased to $64 million in the second quarter from 23 in the first quarter. So if you look at the graph, you start at the left-hand column, you will see we had liquidity available at the end of the first quarter of $511 million. Operating cash flow for the quarter was 108 million. Then we had capital expenditures of 36 million. That's different from what I showed you on the prior slide, because that does not include the 10 million that we invest in Avenir, but it does include 6 million that we spent on dry docking. And then we had other investments, which included was 8 million. That's 10 million invested in Avenir, less 2 million that we received in dividends from our joint ventures. We then took on additional debt. As I mentioned, we drew down on the revolving credit line during the quarter of 130 million, and also, as Niels mentioned, Stolt Sea Farm took on very advantageous loans of $14 million separately. And during the quarter, we paid down $155 million in debt, and that included $110 million approximately on the bond that matured in April, plus regular debt maturities of some $45 million. We also paid $9 million on finance leases, and the FX had a small impact, and thus we ended up at $411 million in the liquidity at the end of the second quarter. Moving to slide 33, what I want to share with you here is that since we acquired Jo Tankers back in 2016 and subsequently took delivery of what was a quite significant new building program, we saw a debt peak really in the first quarter of 2018 at $2.448 billion. And since then, we embarked on a program to reduce debt, control capital expenditures, preserve liquidity, and we have since then seen that our net debt has been reduced by $280 million. And I remind you that this has been through what has been a very weak market for tankers. So even in a weak market for the main business, we've been able to improve on our debt situation. You will see in the first quarter and second quarter of 2020, the little gray boxes on the top, that's the IFRS 16 treatment of our finance leases, so the debt portion of those leases. Net debt now stands at $2.168 billion at the end of the second quarter, so down $280 million. Bottom left, you have our debt maturity profile, and having repaid the April bond, there's not much left in 2020, about $80 million. With the bond that we just issued now in June that actually settled on Monday, we reduced the March 2021 bond from a $232 million outstanding down to $154, as many of the bondholders rolled from that bond into the new bond. And we have 159 of regular principal payments. You see the bonds going forward, the $175 million bond in 2022 is a late 22 maturity. So there's lots of time to prepare for that. As mentioned, we did a bond, 125 billion NOK bond that settled on Monday, June 29th, and it was 522 million that we repurchased. We are working on additional financing, as Niels mentioned, $65 million to be secured by the Moerdijk and Dagenham terminals is the one that has progressed the most at the moment. So if you move on to slide 34, here we give you a view of the liquidity going forward, and this is in light of the bond that is maturing in March, and we want to give you comfort that we are in a good position going forward. So we start with the left-hand column, $411 million in liquidity at the end of the second quarter. Then we did the bond now in June, $132 million, that's SNI01. And you see the dotted line going over to the $78 million redemption of the March 2021 bond. We then had credit approval for a $65 million terminal financing, and where we're working on the documentation. Then over the next 12 months until the end of the second quarter 2021, we have done a conservative, emphasize conservative, of our operating cash flow of about $350 million. We will have further capital expenditures of about $158 million in that same period of the next 12 months. And then we will have debt reductions, regular debt, principal payments of $159 million, as well as the remaining balance of the March 21 bond of $154 million, as well as interest payments, lest we forget, of $131 million. And that leaves us with a liquidity position at the end of the second quarter of 2021 of $280 million. with the next sort of more significant maturity being the September 2022 bond coming. This does not include the $100 million RCF that Niels mentioned. It does not include the terminal top-up financing that we are considering for the Singapore terminal. We also have further unencumbered assets, should that be necessary, that we can also use to finance further or to raise further liquidity should that be needed. So just want to share that with you as a view going forward. And with that, Niels, I would like to hand it back to you.
Thank you, Jens. Before we open for questions, just the key messages that I want to give you is that we, as we showed you, have taken early action to improve liquidity, our liquidity position, and to protect our revenue base. We have secured good contracts in tankers that secures volume. Each business is well positioned within their respective segments. If needed, we have done a downside scenario action plan where we have established further OPEX savings and cash sources identified. So we have made plans in each of the businesses, as I said. If it should happen, we have actions to be taken. We have unencumbered assets, as Jens said, available for further $200 million financing. We have ample room under our covenants. And we have, as also Jens showed you, a liquidity to repay the March 21 bond. It's already secured. And I feel then I feel comfortable with the position that we are in. Uncertain times ahead, but I think that whatever comes our way, we will be ready. And also in these times, there will always be opportunities that arise, and I hope to be able to take advantage of that. Operator, that concludes our presentation. We would now like to open up for any questions that the callers may have.
Thank you. As a reminder, ladies and gentlemen, if you would like to ask a question, please press star and 1 on your telephone keypad. And if you'd like to cancel, you can press the hash key. So that's star and 1. And your first question comes from Eric Halverson from Pareto. Please go ahead.
Yeah, hi. Just first on the opportunities you mentioned there. I mean, it's been a crazy 6 months, right? So what, if you could be a little bit more specific on what type of opportunities, maybe which of the segments you would, I mean, is it mostly on the tanker side or is it across all of your industries? Is it something completely new?
It's not new, and as I remind you, we are very much focused on reducing our debt and conserving cash to ride out whatever downturn comes our way. But we are seeing fantastic opportunities in the tanker business, in the terminal business to expand, which we would like to pursue. I don't think those opportunities will run away, but there are opportunities there for further expansion in the terminal business. Tank container business, we've always, we have expanded through buying or building our own tank containers, but we're also expanded by taking over competitors. So if there are competitors or other platforms out there that are suffering, we would like to see and pursue those opportunities. And then, of course, tankers. I think there is further room for consolidation, and there's many ways of doing that. And I think using our platform and using our balance sheet, hopefully we will be able to pursue some such opportunities. It doesn't necessarily mean that we acquire, but we can maybe see if there's a way of operating pool agreements. So we would like to, to answer your questions, there are opportunities that are arising in each of our businesses.
Understand. And second, when you have more than 95% utilization on your terminals this quarter, yet the EBIT increase from the first quarter isn't that substantial. I mean, is it fair to say that some of the increase quarter over quarter was lower paying storage products, or how should, and second, how has that moved into the third quarter?
So the reason that we had increase in utilization, is because as we said, we have had this challenging market in Singapore. We were able to secure some 3-month contracts with some traders, which is lower paying business, low margin business. So the core business that we focus on, is chemicals. That is steady. That hasn't changed. What we saw the pickup of utilization in Singapore and in Australia is lower paying business but higher volume. So that's why the utilization picked up. It does not reflect that the core chemical market is weakening. It's actually remaining the same and it's healthy. But we just took the opportunity to secure some trader business in that quarter. We'll see if that lasts in the third and fourth quarter.
Okay, but there's nothing on the normal chemical storage business that has changed dramatically over the past, since kind of the craziness of April, I would say.
No, not at all. I would say that to the contrary, we are seeing steady inquiries for storage of chemicals in our main terminals.
Fantastic. Okay, and finally, on the corporate and other operating profit, there's what you say is the delta there of about $4 or $5 million positive on corporate and other, reflecting a lower profit sharing accrual. Can you shed some light on that, and how should we model that going forward? Because obviously $4 or $5 million per quarter is a substantial amount. Is it a one-off?
Yeah. Elaborate. I think it was 5.7 in corporate numbers. Can you elaborate?
Yeah, it's actually comprised of a number of small items, but the big one is clearly the profit sharing. We over accrued in the first quarter, which, if you look at the results, should not have been done, and this was a reversal. I think if you look going forward, you can sort of keep it as a very small percentage of the net profit, not to really confuse the results. This was a one-time correction of an over-accrual in the first quarter.
Okay, so it should still be okay. I understand. Thank you.
Yeah.
And your next question comes from Anders Carlson from Danske Bank. Please go ahead.
Thank you. Just a question on your contract coverage. You state that you are increasing your contract coverage. Can you say a bit more how much approximately you have on the contract or on the COAs now, or
I think it went from,
and how do you see that going forward?
Yeah, I mean, that's again our conservative approach, but we want to secure so it was actually from 70 to 73%, so not that much. But I remind you that most of the contract, because we've been operating in such a weak market for a long period of time, there is not volume guaranteed under these contracts. And so if you do a contract from Houston to Rotterdam for one particular product, the customer is obliged to ship with you at an agreed freight rate from those two ports, but they don't guarantee, they don't have to ship. So there's no guaranteed minimum and maximum volume under the contract. Or there is a maximum volume, but there's no minimum volume guarantee. So what we have focused on is really to fix additional cargoes where there is a minimum volume guaranteed under the contracts to secure the volume that is out there. I am of the opinion that we believe that the market will slow down. When you see, we haven't seen the volume slow down yet, but when you see what is happening in the airline industry, in the car manufacturing, the construction industry, hopefully we haven't seen the impact yet. But if you believe that there's going to be a slowdown in the global economy, we felt it prudent to secure volume too. So we have gone after additional business, and we've been focusing on business that guarantees volume. And actually, we've been able to achieve relatively good rates. As we showed, the average rate increase on the contracts that we renewed was 5%. So that's the thinking.
Okay.
So
in terms of G&A expenses, I mean, it came down from about 52 million last quarter to about 45 million this quarter. How much of that is, temporary effects following, COVID-19, no traveling, no entertainment, whatever, and how much of that could actually be, translated into permanent savings?
Well, it's. I think that we can't continue to have no traveling. We can't continue forever to not hire people. So we have taken dramatic action on as a hiring freeze. So even if people retire or people leave us, we have stopped all hiring, and that can't go on forever. So that will most likely come back again. It's probably going to take a while before we go back to normal, but I would say from 45 back up to, I'm just guessing here, Jens, but around back to 50 million, most likely. And also we did we volunteered to cut the senior management to take a salary cut and the board to take a cut, etc. So once we feel that we are through this storm, I think that it's only fair to compensate for the sacrifices that they made and go back to normal again. On the permanent savings, I would say, as you know, working from home works. We are of course keeping an eye on productivity, but working from home works. So going forward, with the systems, with the technology, and all the things that we've done, there are savings. There are permanent savings that we can achieve. So less office space. I think that we will never go back to the same sort of traveling that we did. We find out that having these Teams meetings works very well. So it will be a difference, but it's too early to identify. But it's very much in our focus to create permanent savings from the experience that we've had in this pandemic.
Niels, maybe I can add. Okay. In the second quarter, we also saw that the U.S. dollar strengthened, which also has the impact of reducing the A&G in foreign currency locations in U.S. dollar terms.
Okay, thank you. And then one final one. In the U.S., I mean, you have the ITC terminal that is probably still out as far as I know in Houston. Are you fully utilized there, or is there more to add on to utilization and revenues in the Houston and in the U.S. area on the chemical side?
So in both Houston and New Orleans, we have lots of space to expand, which we are looking at projects. So even though we have capital expenditure restraints right now, there are projects that we are pursuing and looking at, and we have additional space to build additional tanks. So we've put in place all the infrastructure. As you probably know, we built a new jetty in Houston, and we have the east property, which is not full, so there's plenty of room for expansion there. And also in New Orleans, within our wall, this protective wall that we built, we have plenty of space for expansion there. And really on the top of the priority list on spending or capital expenditure once we open up again is to develop and pursue these opportunities that we consistently see in the U.S. Gulf. Utilization is high both in Houston and New Orleans. We are building additional. There are some tanks still being built in New Orleans, but it's all contracted out. So what we've been focusing on now, since basically utilization is at max, we've been renewing contract, culling low margin business and replace it with higher margin business, and that is ongoing. So that's why I say that without further capital expenditure, I think that we will still continue to see improved earnings from the terminal division, because we've been focusing on, one, getting our operating costs down, but also getting higher margin business into the terminals. So we have expansion for additional land both in Houston and New Orleans, but the growth that you will see in the short run is coming from lower operating costs, but also higher margin business that we're replacing low margin business when the contract expires with high paying business, taking advantage of the relatively strong market in the US Gulf.
Okay, thank you. That's all for me.
Thank you. Operator?
Thank you, and we have no further questions at the moment.
I guess then that completes our presentation. I would like to thank you for taking the time, and we'll talk again when we release our third quarter results. Keep well, and thank you for participating. That completes the presentation.
Thank you for joining. You may now all disconnect.